It's been tough in segments of the Canadian commercial real estate market over the past few years. COVID drove people out of offices, and then interest rates went up, and that's always tough on people in the real estate industry. Our guest says there are signs of an upswing. We're joined now by Paul Morisuti, chairman at CBRA Commercial Real Estate Services. Thank you very much indeed for joining us.
Nice to see you again, Andrew.
So you say that there was a near crisis in funding over the past few years for some commercial real estate players.
Pretty much for everybody.
Okay.
So the biggest issue in the real estate market over the last couple of years has been this sudden increase in interest rates and what we call the cost of capital crisis. And I think the best news in the industry right now is that cost of capital crisis is abating. So last year, you could buy a GIC and get a 6% return, required no CapEx, no management, perfect liquidity. So in that kind of environment, why would you buy real estate? That was the world we were in last year. As interest rates begin to come in and settle, a lot of that capital that had migrated into alternative risk-free GICs, if you will, is now looking for yield again, and it's beginning to move back into real estate. So as an example, Andrew, Q3 of this year, I think the TSX REIT index had its best quarter since 2009. And that is in part capital returning into real estate and the outlook for real estate being much more much better than it has been in the past couple of years.
And now, I know you don't want to get too far into the weeds, but an important determinant, though, of real estate funding costs is also the 10-year bond yield.
Yep.
And so with lower inflation expectations, I guess we would expect that to come down.
We would expect it. The caveat is what's happening in the U.S. right now, and particularly the unease and the uncertainty around what Trump will actually do in terms of tariffs and deportations, both of which, if he does what he says he's going to do, are incredibly inflationary. And I think a lot of that uncertainty has kept those 10-year Canadas and the 10-year rates in the U.S. more elevated than you would expect. So going forward, that is something that we are watching very carefully.
It has been tough on office real estate, and broadly, I mean, it's obviously a very varied market, but you do see the vacancy rate climbing into 2025.
Yeah, we've been quite vocal in saying it's going to continue to go up, but at the same time, the market, I think, is getting better and is better than people realize. So for the last couple of years, we've characterized the office market as commodity versus trophy, or the best versus the rest. There's this issue of bifurcation has characterized the sector. Going forward, bifurcation is not a good enough descriptor. It's going to segment more. So what we think will happen, Andrew, is at the top of the tree, you'll have brand new net zero assets for which there will be enduring demand.
And, wired for technology, I guess, is part of it as well.
That's right. Yeah. All the bells and whistles. A step down might be older buildings, but still well amenitized, good sustainability credentials. We think those are going to do well and will continue to recover nicely. There will be another step down, which will be a swath of inventory where performance will be uneven, to be honest, and then another step down of assets that may never recover. So the office market is evolving. Some of it is still struggling, but there's an awful lot going on in office that's better than what people realize.
That's interesting, because I suppose some employers are desperate to bring the workers back from working from home, and a fancy building helps, nice amenities.
It does. The return to office pendulum is definitely swinging back in favor of more time in office. And I think, one of the things that we'd point to, there's been all kinds of company announcements about we want people in 5 days a week, or we're going fully remote. I don't pay too much attention to them, but this year, McKinsey told their people, we want you in the office more than you have been. McKinsey is a management consultant that advises companies on how to optimize their performance. If they're telling their people they want them in office, to me, that's very telling.
that the clients are
Yeah,
also
that's right.
expressing those views.
That's right. So remote work hasn't gone away at all, Andrew. It will continue to have a place in the real estate world going forward. It will be a factor going forward. We've never believed it was the category killer that everyone thought it to be. And as I said, the pendulum's swinging in the other direction now.
Over the next few years, if I run a demolition company, will I be busy knocking down some of these older sort of third-tier office buildings?
I think you might be. I think the phrase I used this morning is the office sector is not oversupplied, it's under demolished. So we do have a lot of inventory for which conversion is not really economically feasible.
The location may be not good.
Well, or the building physically may not lend itself to conversion. But if you can demolish it and get some additional density and eventually build on it, I think you're going to see a lot more of that activity over the next few years.
I can